What is going on, everybody? So it's 6 o'clock in the morning. We're drinking some coffee. Let's bring you some market updates and what's going on here. So yesterday, Papa Jerome came out. He said to everybody, I don't care if the bank collapses. I don't care what's going on. I'm going to keep raising rates because I'm the man of the house, right? So here's what happened.
How seriously was a pause considered for this meeting?
We did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time.
The brief version of it is that the bank collapse had nothing to do with the interest rate hikes and that they are set on restoring price stability and getting back to a 2% inflation rate. First of all, let's understand what happened the past few years, right? Because I have not given you context. So in New Zealand, around 1990, this thing came around that it was like, let's say, a ceiling for inflation, and that was 2% inflation. That was their goal. They were aiming to have inflation between 0 and 2%, and that wasn't the goal to strive for 2%. The goal was that would be the ceiling, the max of inflation. This number, that 2% inflation the Fed is obsessing over, came out of New Zealand around 1990. Now, this was a ceiling. The thing is, right before coronavirus, right, and all this madness that they started printing money like crazy, the Fed realized, and especially when the whole thing started, they realized that they're under that target of 2% inflation. This is what caused this madness of printing on top of supporting the economy because of coronavirus. But even before that, they realized that the 2% inflation target wasn't on point, so then they started focusing on printing money, supporting the economy, and making sure that the inflation is gonna hit that 2% number. And they tried to make this a target, and that was supposed to be a ceiling. So now let's see what happened at yesterday's meeting, that they raised the Fed's fund rate by 0.25% to 5%. So here is what happened, right? Yesterday, the Treasuries rallied as the Fed decided to raise the Fed's fund rate to 5%. After the Fed raised the benchmark rate by 0.25%, as traders ramped up bets, the central bank will soon reverse course and start cutting interest rates. They are certain the Fed will lower rates by July to at least undo this week's increase, according to swaps tied to the policy meeting date. So swap traders see 50% chance that there is not gonna be another interest rate hike. Papa Jerome said that he might raise the interest rates a couple more times. Economists see that by July we might stop raising rates and might be in good shape. Now don't forget, next year there is an election. Joe Biden doesn't want to get stuck in the middle of this situation where there is a recession, he has to run again. So this sounds very reasonable. Now here is what Jerome said in 2001 about raising rates, right? He says, frankly, there is good research by staff in the Federal Reserve System that really says to look at the short first 18 months of the yield curve. That's really what has 100% of the explanatory power of the yield curve. It makes sense because if it's inverted, which right now it is, here is a picture, because if it's inverted, that means that the Fed is going to cut, which means the economy is weak. That's what Jerome Powell said March 21st, 2022, which is last year, right? So the yield is inverted. This is where we are right now. This is when they first started raising rates. They gave us a guideline of what is going to happen a year ahead. So this is where the yield is. The yield is inverted. This is where we are. And one thing I want to tell you about you guys that you're thinking, hey, is it a good time for me to start putting money into the stock market? Is it a good time for me to start reinvesting and doing some moves, right? First of all assets compete against each other. You got to always remember that as the economy adjusts and things fluctuate and new data comes in and policymakers change the policies to make sure that new things are gonna come into play, assets compete against each other. And what this means that treasury yields or bonds of companies or savings accounts, right, starts competing. So then there is a risk reward situation where if you can put your money in, let's say, a CD for 4% or like a savings account for 4.5%, why would you put your money into stocks and risk the economy going worse and losing more money, although you can get this 4% guaranteed, right? You can do treasury yields right now of the United States of America and get 4.5 or 5% back within 6 months, right? So why would you even start going risky routes like, stocks, although you can get money guaranteed and then not lose your principal. Well, this is what it means when you hear all assets compete against each other, right? Now, when does money start rolling back into the market? Money starts rolling back into the market when the returns on these safe havens start going away. And this happens when the Fed stops raising rates. Now, when is the right time for you to time that is when the Fed is gonna come out, according to this, probably around July, and they say, hey guys, we're done raising rates. I think we pushed it too far. You know, it's time for us to support the economy again. So when this happens, money starts flowing back into the market. Why does this happen? This happens because the markets are a forward-looking mechanism. And what this means is that the markets doesn't look what happened today. They look what's going to happen in 6 months and when the economy is going to be and where the economy is going to be then, right? So when the last money is entering the market is when the economy is good. What you want to do is like front that curve. If you see it as a bell curve, right? You got to front that curve in the beginning. You got to remember, all assets compete against each other. You gotta be aware of that. And right now, if you wanna take a risk, you're one of the few players that choose to be in the market. I mean, good, do it. And this is a great thing to do, especially if you're on a day trade because you're in and out of the market really fast. But overall, if you're a long-term player, you still don't have to care. I mean, make an investment is gonna pan out in 10 years. It's not a big deal. This is what Papa Jerome said. This is where we are right now. And you know, you guys be strong. We're almost out of it. It's an election year next year, like I said. It's not gonna be that bad. And I mean, you know, it's like, how do you not pull that band-aid, right? Do you not just rip it apart and tear some skin off? Or do you not just pull it slowly and like the hair is gonna start hurting? This is the situation here. Jerome is knowing what he's doing. He's pushing it to a brim and he starts saying things that the bank collapses has nothing to do with raising the interest rates, which is nonsense. But the truth of the matter is they gotta do their job. They're set on a certain number, and the biggest secret here is do not fight the Fed. Do not fight the Fed. You gotta swim with the Fed. You gotta make moves according to what the Fed says, as much as you might not like it. And lastly, the one thing I want to tell you guys, just like Warren Buffett says, right? I got two quotes for you today. I got a Winston Churchill quote and then I got a Warren Buffett quote. So Warren Buffett says, when the tide goes out, you see who's swimming without any underwear, and this is the case here with Silicon Valley Bank. All these banks that they start not hedging, which is madness on itself. Like, why wouldn't you hedge when you manage billions and billions of dollars? God only knows what's going on through their head. They take all this money, they go lend it out 10 times, and then the question is, why won't you hedge your bets and then over leverage on one side? Nobody knows. So Warren Buffett says, when the tide goes out, you can see who's gonna be naked. And then Winston Churchill says something else: never let a good crisis go to waste. This is where we are right now, guys. Start looking ahead, not just 1 year, but look ahead 5 years, 10 years. You look back to here and say, God damn, things were so cheap and I didn't buy. I didn't buy real estate, I didn't buy stocks, I didn't invest my money. When times are hard, it's time for you to maybe double down. I love you all. It's been a while. Standing Alex is here. I'll catch you guys soon.